and welcome to Dotcast Episode 2. I'm Christine Tsai, the co-founder and CMO of Dot Investing. I'm so happy to be out and enjoying the sights and sounds of London that I never thought I would miss it so much. It's been nearly 2 years since the pandemic started in the UK, and now it finally feels like life is beginning to return to normal. So many of our investors, listeners, friends and family have been asking, what's happening in the UK commercial real estate property market as things are slowly getting back to normal, and how has it been impacted by the pandemic? So today we're delighted to have our head of investments, Luke Dixon, and managing partner of Yoo Capital, Lloyd Lee, with us to talk about the latest development in London commercial property and the trends that are shaping London in the post-pandemic world. So without further ado, let's jump into the discussion with Luke and Lloyd.
Hi, my name is Luke Dixon, and I'm the head of investments for Dot Investing. And I'm joined today by Lloyd Lee, who's the managing partner at Yoo Capital Management, a specialist investment real estate investment boutique in London. And we're really honored to have Lloyd with us today. Yoo Capital is raising its second fund right now. So Lloyd's pretty busy with transactions as well. So he's carved out some time for us this morning. So thank you very much for that, Lloyd. Lloyd's been involved in over 12 billion pounds of real estate transactions in Europe and in the US, and recently been focusing much of his time and energy in around London, which is the topic of our conversation today, which is how are our real estate markets responding principally to the pandemic. I think that's what is on a lot of people's minds today, but also, of course, to Brexit. It's easy to have forgotten that the UK left the European Union a couple of years ago. It's been overshadowed recently by the pandemic and work from home orders and shutting down of restaurants and entertainment venues, and undoubtedly had a pretty major impact, I would think, on commercial real estate. But also obviously on residential real estate as well. And we've got Lloyd here who's going to walk us through what's happening in the market. And really pleased to have you join us today, Lloyd. Thank you.
Thank you very much for having us.
So the first thing, let's just get it out in the open here. What has the impact been of the COVID pandemic, of work from home orders, of restrictions? What has been the impact on commercial real estate in London? What have you seen over the last couple of years?
Any exogenous factors that come into your sector, you have to basically always tie it back to fundamentals. It's dangerous whether it is a dot-com bubble or it's a great financial recession or it's the risk of inflation, Brexit, or COVID, to look at the near-term impact and not tie it back to real estate fundamentals and start extrapolating conclusions. So for us, when we look at the impact of COVID, we don't look at the fact that offices today are largely empty, or the fact that there was a time not that long ago when restaurants were closed, and try to extrapolate how that would affect the world from that point. What we did is we went back to fundamentals. So we actually talked to major employers. We went back to the restaurant industries and the hospitality industries and actually spoke to them about their medium and long-term plans, not the immediate near-term issues that they were facing. And as a result of that, over the course of the last 2 years, where we have spoken with some of the largest names in hospitality, entertainment, banking, finance, creative industries, music, what we've understood is that in spite of the fact that there are factors today of a completely unprecedented nature, the medium to long-term impact that we see from the industry, while still technically not 100% clear, now has very strong fundamental roots in coming back into the workplace, coming back into restaurants, coming back into major exhibition venues, live entertainment venues, stadiums, and areas of public gathering. And the reason is because the fundamental requirement for space, human interaction, in-person meetings, live entertainment, we think has strong undercurrents that even during COVID, we already saw. And if you look, and we kind of make a joke about this, if we look at what happened when we had some relatively positive signs during COVID, but we're not 100% clear yet. It's funny to see that the offices Monday to Friday were empty, but the pubs, as soon as they opened, were full. And I'm sorry to say, that is one of those small human nature signs that, in fact, people do want to get back out into the real world again. And as soon as they think they can do it, they will do so. So as a result, when we then took that fundamental measure from the industries, we started engaging with them on, well, what does your space look like in the future across all of these various different asset classes? And what we discovered is that people are doing something that we in our industry already saw as a major trend before COVID, which is that major employers and occupiers of space said, I'm now looking even closer at the quality of my space, the quality of my collaboration spaces, the quality and the health of my space. How much outdoor space am I going to get? What is the quality of my air filtration? And as a result, health and safety, which was always something that we thought the industry should focus on and has done so, is only being asked to look at that again and move it 2 or 3 generations further along. And as a result, in looking at our portfolio, we've recognized the importance of that, number of years ago. And when you look at the quality of the design work that our teams have done, the quality of space that we have been delivering for the last 10 years, there is a reason why, whether it's the platinum ratings in environmental responsibility, whether it is the quality of air filtration systems, the quality of light, the quality of space, the density at which you're packing your offices, not just for COVID, but because having greater spaces, greater conference room areas, public gathering spaces, breakout spaces for impromptu internal meetings are part of the future of the working environment. And COVID has only accelerated those trends. It did not create them. They were already here as, again, a fundamental part of our industry.
That really resonates with me. Before joining Dot, I worked in the big corporate finance world, and we had space in our building that was very collaborative, sort of very, I guess, high tech in nature, foosball tables and beanbag chairs and PlayStations and lots of collaboration space with whiteboards, intermixed with other floors, which were austere wood paneling, very traditional kind of investment banking type of environment. But things were changing. We were beginning to hot desk, and that was happening more and more often as people began to work more flexibly. And as the company looked to make better use of the space it had, even as its workforce was growing. So I can see very much how, with that longer term view, you were able to stay the course and see that some of these trends were simply speeding up rather than changing as a result of COVID, which is interesting to me, given how, in a sense, the world changed so much over the last 2 years, very, very rapid, almost overnight, right? From packed trains to empty trains and empty offices. I think there was a real sense of fear early on that this could mean it's at the end of, the accelerated end of traditional bricks and mortar retail. Will high streets, will the likes of Regent Street and Oxford Street in central London, what will become of those spaces? And what you're suggesting now is even in with all that gloom and fear that existed early in, say, Q1, Q2 of 2020, when all these pandemic restrictions were relatively new to us, you were able to step back and have, a very clear-eyed discussion with companies, with landlords, with occupiers, and people weren't in a panic mode. That essentially these visions remain the same. I mean, I guess real estate's always a long-term business. It does surprise me a little that there weren't more, in the first wave of pandemic reactions, that there wasn't a bit more panic in the market. Or did you see some panic in the market? Were there great buying opportunities for a moment?
I think what we saw was a mixture of reactions, and it's not that different than any time you see kind of emergency scenarios. You generally find that reactions will vary. Some who will panic, some who will be ignorant, and some who will try to be measured about what they're seeing. In some cases, quite alarmed, and in other cases, quite prepared. And I think what we saw, to your exact point, was that in the marketplace, when things first started to happen, we did see some panic selling. But we also recognized that, particularly within the London market, London's seen a lot in its years. The city is 1,000 years old. And I think one of the first things we did in terms of going back to fundamentals is we went back to 1918, which is, it was interesting to us because we studied as much as we could about what happened in 1918. And one of the things that occurred to us is practically nobody even knew about 1918 until we all went back to the history books because of COVID to read up on it. And so here you have this great pandemic of 1918. Not a single person in our generation before or after us even knew it existed and had carried on for life, packed offices, packed trains, more packed than they were probably 100 years ago. We forgot. And so that was the first sign that this too shall pass. Because frankly, we not only had it pass, but we didn't even remember to think about it, 100 years later. And as a result, we started looking at the recovery rates, what people were doing, what happened to real estate, to spaces, to uses. And I think the answer that we came to at the time was, unless this particular pandemic ends up biologically, out of control forever, within the confines of what we saw in history, the world reverted back to the norms within a reasonable period of time. And so that was kind of data point number one. Data point number two is when we started to look at where parts of London were emptying out, and we started watching what was happening on Oxford Street in the retail stores and the offices. We looked also at what those areas were in our analysis before the pandemic, and we realized, well, actually, many department stores already were on their way out. The fact that they're now shut has only forced landlords and operators to think, well, I'm now going to be closed for an indefinite period of time. Is this really my best business model? Because I knew before the pandemic, I was already rethinking it. And now it's happened, as you said, is that the rethinking element of how do I basically become a sharper, more forward-thinking real estate owner or operator has simply been accelerated in the last 24 months dramatically. And I think as a result of that, what we're seeing is that the world will emerge out of the pandemic faster, better, stronger, sharper in terms of what they are providing the world in their real estate. Our view is that London, being a gateway city, was always under pressure pre-pandemic to offer the best of what the world had to offer. And what we saw specifically was that the world is expecting gateway cities in their real estate to provide more services, more convenience, more accessibility, more health, more environmentally sound and sustainable construction and design methodology, less traffic, less pollution, better accessibility for people to collaborate, to meet, to show clients. All of those elements were key trends that you could see coming because the world is expecting it. And particularly, you will remember, people have been talking about serviced offices for quite a while now. And we've had already a bit of a shakeout in that sector. But the fundamental point that people are expecting to have flexible spaces with high quality spaces, high quality services in those spaces so they can flex their workforce and their requirements, that had nothing to do with the pandemic. It was already a major global trend that was coming forward. And as a result, when you then extrapolate that out to hospitality, to residential, again, offices, we saw that the world was already starting to think about how to take it one generation forward. And we've just had 24 months now to do it a bit harder and a bit faster.
Very interesting. You mentioned residential in the last sentence there. Those of us who live and work in around London, we've witnessed that house prices have gone up, rents have gone up in the residential side quite considerably, as a matter of fact. Just getting into the details of what's happened over the last 2-3 years in London real estate, how have cap rates changed? Have there been any material changes in lease terms commercially? Are people looking for shorter leases now, maybe more breaks in the lease terms? What's been happening in the details of contracts in the real estate market that are noteworthy?
I would probably say two things. First is that on a global scale, because investors today tend to be quite global and very sophisticated in real estate, London continues, and the UK market generally continues to be one of the most attractive markets for investors. And the reason is because the legal system is stable, but particularly within the real estate world, the structure of the leasing that happens in London is very landlord and investor friendly. You tend to have longer leases, good protections, and very, very low levels of supply. And so as a result, it means that you've got a very, very stable investment market in many, many different asset classes across real estate. And so what's happened during crises like the pandemic is that, setting aside lease structures and duration, et cetera, institutional capital in core real estate has come into London because it is considered a safe haven. And that has happened time and again, cycle in and cycle out. And we saw it again in 2020 when London, I believe, attracted more core inward investment in real estate than any other city in the world. And that's been 5 or 6 years running now. And it happened again in 2020, 2021. And I think it's because people consider real estate, in London a good long-term investment. It's got safety measures built in place. It's got income measures that basically help ballast against exogenous risks, inflation being one of them, which I'm sure we'll cover today. And so I think from that standpoint, what it did then is it actually maintained an anchor and a ballast on cap rates relative to some of the risk factors of COVID and what was happening with those income streams. And so as a result, over the course of all the real estate asset classes, cap rates as a sector across all of real estate have remained relatively stable in the core market. Where you've seen cap rates widen is on the riskier assets. Anything with construction, development, no income, speculative, the yield and the risk appetite for that have obviously changed quite significantly. And I think that is probably a prudent way to approach those assets and those investment types. But actually for guys like us, for our firm, that is actually an area where we've always focused. And so for our particular business, we have seen in the last 12 to 24 months that it's not that pricing has simply changed. It's that actually there's been a lot less activity in the opportunistic space in London. And as a result, we have found those times to be the most active for the firm. And in the last, probably 2 years, we have deployed we've committed about 200-300 million sterling into central London assets that are under pressure and are going to undergo quite substantial change under our watch. And when we showed up to those investment opportunities, there was really literally no one else. And I think it's because for those assets with real risk in it, you're right, the pricing metrics have changed quite a lot.
So in some sense, it's a buyer's market at the riskier end. So for the sorts of things that you were doing.
The way I would say is it's a stock picker's market, in the sense that if you are selecting the right opportunities, you can find some very attractive investments. I would not say that like anything that you see is a bargain just because everything's fundamentally cheap. I do think that there is some very serious risk in certain asset classes that could potentially warrant a big movement in price. But at the moment, we don't see that the pricing that has moved across certain of those asset classes is wide enough. I think there are some areas which have still yet to go a little bit further. We're starting to see more deals come to us from the administrators and the bankruptcy insolvency guys than we've seen in a little while now.
And that's a great segue to the next question, which was really, are there any specific examples of London assets where you're active? So London assets that have either sold really cheaply or very expensively in your view, Whether you've been involved with them or not, maybe you just observe those transactions from afar.
We've definitely seen core assets continue to trade at some pretty keen prices. We've seen some big blocks in St. James, which is in Mayfair, which is super prime real estate. And that stuff is traded in the threes. And
this is commercial office space, is it?
Commercial office space. It traded at 3 3/4, St. James. And we were told by one of the underbidders, had they waited another quarter, probably could have gotten 3.5. And it's because the market for core St. James real estate just started piling in. I think they had 35 offers.
Wow.
It was quite telling. And this would have been only about 6 months ago. So quite telling about liquidity in London for high quality assets with income in it. And we're still talking cap rates in the high threes. So that's pretty strong. At the same time, we have seen major deals in retail shopping centers, prime retail shopping centers, trade in the eights. And that's because there is not only the risk that's happening today of COVID, but we go back to fundamentals, which is you go back pre-COVID, were shopping centers under pressure as a business model because they still have yet to reinvent themselves to compete with not just online, but actually the experiential retail, the high street retail in great locations in London, which are now pooling consumers who say, if I want convenience, I do it from my desktop. But if I want to go shopping in person, I want an experience. And so for me to go down to the traditional model of a shopping center, which I've been seeing for the last 20 years look about the same, I think that sector is under pressure. And so the question is 8% the right number? And I would say for some shopping centers, maybe, but for others, it's probably not enough.
How are those shopping centers being redeveloped, whether they're in kind of central London or, I guess this is maybe not so much a London question, but in more suburban areas where there have been some pretty large shopping mall complexes built, particularly I'm thinking of maybe perhaps more of North America, but how are those being redeveloped to remain relevant today?
People are going back to the drawing board. Not even saying, I think it's an upgraded shopping center, or we're going to expand it or contract it or renovate it or upgrade it. I don't think it's a shopping center at all anymore. They're going for last mile logistics. They're going for smart logistics. They're going for big box of alternative uses. And I think that in some cases, because real estate is about location, if you've got a well-located shopping center that's not fit for purpose as a shopping and retail destination anymore, but it's still on the highway, it's accessible to a very dense population of people, which it should be if it was a shopping center, you might find that other alternative uses are now appropriate for the same location. And I think that makes sense. At the same time, in the same way that we saw some panic attacks as a result of the economic implications of the pandemic, I think that we have also seen that a complete eradication of the concept of retail in some shopping centers is probably an overreaction. But what does need to happen is if you're going to do retail in those shopping centers, it needs to compete with the best available and future available retail experiences that are coming to the fore. It cannot just simply be that you put more paint on the same box and hope that the same retailers will now survive. You need to look at your retail mix. You need to see who the retailers are of the future. You need to work with them to create great experiences where people will love to come and shop and be entertained. And I think a huge part of retail is entertainment, and that includes hospitality, includes food and beverage, includes restaurants. And I think if people make sure they remember that when they look back at the drawing board and not just simply discard it, they might find that some shopping centers come back as retail experiences, but much stronger. And people are already used to going there for retail shopping experiences, and they actually do really, really well, as opposed to throwing the baby out with the bathwater. But I think that's going to be very much a case-by-case basis.
Inflation. You raised it a few minutes ago. Real estate has traditionally responded well to inflation. It's been a safe haven asset class during times of inflation. Do you think that remains the case, or is inflation somehow different this time?
I don't think it is different in that, real estate is a good hedge for inflation, but we have to remember something about how that works. If everything is equal and you have a low supply environment and inflation goes up, your rents will follow, and that is a good hedge. The challenge is when you end up in a high inflation market, other things change in the equation. So it's not all equal. It's not all the same. Certain businesses go under. They can't keep the employment levels as high. Space demand starts to weaken. Rents then come under pressure because you don't have as much demand for your space anymore. So we have to be careful about assuming that just because inflation is hedged in the real estate world, which it is, that means by definition, if I buy real estate at 10% and inflation is 3%, I'm at 10% plus 3%, no big deal. The reality is that's only true if supply side and demand side stay equal. Now, the good news is if you look at the London market today, going back 12 years, there is a fundamentally strong reason why we are in a low supply environment. Between the great financial crisis and a lot of the restructuring that occurred for 3 years then, where the credit markets pulled away from the delivery of new supply, and then the fact that unlike other markets, which continued to be buoyant after 2013, 2014, we had a hard stop again with the credit markets in 2016 with the Brexit announcement. So that then forced the credit markets to stay away from the UK market specifically and deploy outside the UK borders to see what happens with Brexit. And then we had the great pandemic of today, and the credit markets again are stalled. So as a result, London has been undersupplied pretty consistently for 12 years. And when you think about how long it takes to bring supply on, as you said, real estate is a long game. We find ourselves in an unusually tight market. And so far, we would say that if you look at most of the major asset classes in good locations with good real estate, the demand has remained fairly stable throughout the pandemic. And as a result, what we see over the next 24 to 36 months is not just a continuation of the demand, but actually a continuing erosion of the limited supply that we have. And I think it's fair to say that major employers in London have in the last 6 months started to wake up to that fact, because when they look out and say, I'm going to need space in about 2024, 2025, and they ask the agents, what are my options? The agents usually say, if you need 100,000 square feet, there aren't that many. I can show you some speculative land. It's got no planning. They're going to have to go to planning on it. They've got, 3 floors here in a not ideal configuration. There's not a lot of space. And so what we're finding is there's quite a lot of activity at that major employer level in London today looking for space in 2025, and they're not finding it. So overall, I would say that when you think about inflation and you look at our supply side here in the UK, specifically London, I do think that actually London is going to provide a reasonably attractive place for capital to find a haven in investment in core real estate.
Lloyd, this has been a really, really interesting discussion. If I can recap in a nutshell, what you're suggesting is that London has been and remains one of the most attractive commercial real estate markets amongst major cities globally, that trends that were already fairly well established pre-pandemic have largely remained in place. They've perhaps accelerated, but those trends have not fundamentally changed. And the fundamentals of real estate have always been critically important to evaluating and valuing real estate. And that hasn't changed. The pandemic hasn't changed that whatsoever. So London still remains one of the most attractive commercial real estate markets available today.
It is, and I will say, the litmus test is what have you done? Well, we've deployed a couple $100 million of capital in the last 12 to 24 months, but we also, on our existing portfolio, have signed leases in the most COVID vulnerable sections: hospitality, food and beverage, live entertainment, with some of the biggest names in global hospitality and entertainment. We've signed 400,000 square feet during COVID last year. Starting out in January, we already have 200,000 square feet in early stage negotiations. So from our perspective, everything you said is correct, and the demand is actively here today. And we think that portends for a very interesting 36 months for us.
That's fantastic. Lloyd, thank you very, very much for sharing your insights with us today. I think our listeners are going to really enjoy hearing from you and just hearing in general what has happened with the real estate market. I think you've probably put to rest a lot of concerns that people have had as they've contemplated investing either directly in London real estate or through funds. And I think it's been really insightful and certainly for me a great use of the last 40 minutes. Really appreciate it.
Thank you very much.
I hope you all enjoyed today's Dotcast. If you have any questions about today's topic or any ideas you'd like us to cover in the future, please leave your thoughts in the comment section below. And please follow us on LinkedIn and subscribe to our newsletter at dotinvesting.com to get more information about the trends and insights of private markets. Thank you for listening today. We will see you at the next Dotcast.